Good afternoon, everybody, and welcome to this edition of our Think Learning webinar, Use Price Action to Spot Trading Signals. Today is Tuesday, June the 1st. My name is Carl Capilingua. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we delve into one of my favourite technical analysis tools. And it is the basis of really all of the analysis I do here at ThinkMarkets. Let's talk about the ThinkMarkets difference before we get started though. $8 flat rate ASX trades, your own holder identification number, so your trades and your holdings aren't pooled with other users. Unlimited phone support, no pesky chat windows to get your problem solved, and no hidden platform or subscription fees. 4 fantastic reasons why your next ASX share trade should be with ThinkMarkets. And if you are new to the ThinkMarkets family and you sign up before June 30, get trading, your first 5 trades are on us, as is usually the case with these sorts of things. There are some terms and conditions, so please head to the website for further details. The agenda for today, I hope to deliver you a usable price action methodology, but we will start with a brief introduction to technical analysis, because in these sorts of webinars I cater for all comers and assume a very basic level of knowledge, but don't worry, we will ramp it up to the point where your brain is hurting very quickly. We'll talk about price action, we'll talk about trends and trend following, and then we will discuss a very specific price action based trend following strategy. So very quickly, what is technical analysis for the uninitiated? If you've been following me on Twitter or my articles through ThinkMarkets, you know that technical analysis is a very large part of what I do. It's not all of what I do. I do a lot of the other type of analysis, which is called fundamental analysis, and that's where we break down all of the inputs into a business. If we're analysing a company listed on a stock exchange, so we're analysing the profitability of the business, management, broader industry-based themes, and then macroeconomic themes to determine the future profitability of the company, and then we discount that profitability back to a current valuation, compare that to the share price, and then we can get an idea of whether we've got a cheap stock or an expensive stock. That's pretty long-winded, it's quite complicated, and you generally need half an alphabet after your name on your business card to be able to do that. Many, many years of study and practical application. Technical analysis is a great leveler, and I'm a big fan of technical analysis. I didn't start out that way. I started out as a fundamental analyst in the industry, and slowly learned about charts and found more and more that while the fundamentals can tell me if I've got good value or not, the technicals tell me when is the right time to trade. Technical analysis tells me when the market is agreeing on a particular stock, or it could be a cryptocurrency or a foreign exchange pair, whatever you like to trade. So technical analysis for me is about market consensus. That's big picture stuff. Nitty-gritty stuff, it's really as simple as price on the y-axis, volume on the y-axis, time on the x-axis. Let's have a look at a picture. I think that's the great thing about technical analysis as well, is it's all pictures, and human beings, very pictorial creatures. We can look at a picture and get a lot of information very quickly. And we can see on the screen, we've got a squiggly black line here, which is the price. Price axis is over here on the right-hand side. We've got time over here on the x-axis running along the bottom, and we've gone from roughly 1993 through to current time for this stock, which top left corner there is ANZ. It's an Australian banking stock. We're going to, just going back to this slide, we're going to delve into the nitty-gritty within each of these squiggles and try and make sense of a stock's trend, and then from that when we should trade. Okay, price action, as I said, it's one of my favourite sort of sub-topics of technical analysis. Technical analysis is a massive, massive area of study. Price action, for me, is where you need to start, really. You can put 100 indicators on your chart, but at the end of the day, those indicators are derived ultimately from the price, the open, high, low, and close. And there are intraday signals using the open, high and close. So that's up here on a day-to-day basis. And typically what we're doing there is bar and candlestick analysis. Then we've got intraday signals for more than one day, and we're starting to build up sequentially over extended period of times, trends. And then we've got pattern analysis. So for example, support and resistance, triangles, head and shoulders patterns, cup and handles. What I'm going to focus on today is this area here, and we have had other webinars in our Think Learning series that are focused on some of these other areas, and we will no doubt have other webinars where we'll focus on them in the future. I've got half an hour to teach you as much as I can about price action, and this is the area we're going to focus on today, which is identifying trends. For me, I like to see when trends are in alignment. So I need to identify short-term, medium-term, and long-term trends. If all those trends are in alignment, it's telling me that shorter term traders, now these are people who really are in a security, whether it be again a stock or a crypto or an FX pair, for a very short period of time. It might only be a few days, it might only be a few hours. But we're looking for, again, market consensus. What is the consensus of the shorter term traders? We've got medium term traders trading the market, creating supply and demand. They might be in the market for many, many days, up to weeks, and maybe up to a few months. What do they think about the market based upon their analysis? And then we've got longer term traders who are more positional. This is really, to me, this is the big money in the market, and you don't want to go against these guys. But they are trading not for days, not for weeks, they're trading for many months, if not years and beyond. So when we have an alignment of these three trends, we've really got an alignment of the various players in the market and a consensus that a stock or a crypto, whatever it is, the security could be hopefully heading in a particular direction. Now, don't forget, they're all doing their analysis in real time, and the demand and supply they're creating is based upon their expectations. So yes, there's this often an argument that technical analysis looks backwards, and certainly, we are seeing price history, but the analysis that is creating these three trends is based upon expectations. Okay, so we are almost looking into the future, and when we can get that alignment, we've got something very special. Okay, so let's work on some hard and fast, some very explicit definitions of these three trend timeframes that you can start using as soon as this webinar finishes. What we're seeing on screen is the short-term trend, and the short-term trend definition is very simple. It's simply based around the highs and the lows for each period on the chart. And if you can get yourself a chart and you can hover over a bar, it won't happen now because this is a PowerPoint slide, but if you can hover over a bar on your charting package, generally a little pop-up window comes up and it tells you what the high, low, close, volume, etc. is on the day. And the definition of a short-term uptrend, let's start with a short-term uptrend. I'm going to use this abbreviation throughout the presentation today of STUT, is simply today's high is higher than, let's call it H-1, previous high, and today's low is higher than L-1, okay? And everybody should be able to do that on a chart. Now, there are some minor variations. We're going to see inside bars, outside bars, etc., but this is the most basic definition. As a tip, I would say ignore inside bars. A short-term downtrend is just the opposite. We've got now lower highs and lower lows. So today's high is now less than high -1, and today's low is less than low -1. And it's a very, very basic definition, but we're going to build this up. This is what the short-term traders are thinking. Moving on to the medium-term trends. Now, a medium-term trend is a series made up of a series of medium-term peaks and medium-term troughs, and we've got the abbreviations MTP for medium-term peak and MTT for medium-term trough. Now, medium-term peak is defined as the highest point, so we're looking at the absolute top of that particular candle or bar, the highest point between a short-term uptrend and a short-term downtrend. Now, I don't need to redefine those because we've got those definitions on the previous slide. But you can see here higher highs and higher lows, which then change to lower highs and lower lows. And the peak is simply the highest point between the two. The trough is just the opposite. It's the lowest point between the short-term downtrend on one side and the short-term uptrend on the other side. And once again, as long as you can find a chart, hover over a bar, there's absolutely no reason why you can't spot every medium-term peak and every medium-term trough on a chart. So I'll just go through and draw the rest of these in. Medium-term peak here, medium-term trough, you've probably already spotted them. Medium-term peak and medium-term trough. It's important to note that we don't know where this next medium-term peak is going to be because it hasn't been formed yet, and we literally don't know until we have the short-term downtrend coming down the other side, and we're just literally waiting bar by bar for these things to occur. Never assume something's going to occur. Okay, the medium-term uptrend is defined as, well, remember, short-term uptrend was higher highs, higher lows. So it makes sense that the medium-term uptrend is higher medium-term troughs and higher medium-term peaks. Okay, medium-term downtrend is just the opposite, lower medium-term peaks and lower medium-term troughs. And the tricky bit here is understanding the point at which these medium-term trends commence. And it does kind of depend on what's coming before it at the start. So let's maybe focus more on the middle, and you'll understand what I mean by that in a second. And if we look at this point here, and maybe some people have already spotted it, as soon as we break below this medium-term trough, okay, whatever price that might be, we have already got medium medium-term peaks in place. So medium-term peak, if we call this 1 and we call this 0 for argument's sake, so we can say that medium-term peak 1 is clearly less than medium-term peak 0. Now, let's say we're at point A here above this break, and point B is below the break. At point A, we still are in a situation where the medium-term troughs are rising. Okay, but at point B, when we've broken below the medium-term trough, and let's call that medium-term trough 1. Let's call it 1. We know that wherever medium-term trough 2 is going to be created, and we don't know where that's going to be. I mean, it could just keep going down and down and down. But wherever it occurs, it's going to be less than medium-term trough 1. So wherever it occurs, remember, we can't see the future. We're at point B. We've just broken through. Wherever medium-term trough 2 occurs, and this is a little bit of a question mark right now, it will be less than medium-term trough 1, and therefore we have our conditions for our medium-term downtrend. So to answer the question of, well, where do these things commence? You don't always have to see lower peaks and lower troughs in place to get a medium-term downtrend. You just have to be at a point where you know that next trough is going to occur at a lower price than the most recent one, and have the medium-term peaks in place. The medium-term uptrend is simply the reverse of that, and that is where, let's just go medium-term peak 1 is greater than medium-term peak 0, and medium-term trough 1 is greater than medium-term trough 0. And this explains why I said before we need to kind of know what's happening back here to define where the uptrend commences, because we need to know, for example, if this is a medium-term trough, and we can't tell from the information we have. Now, if there's a bar coming down like this, a red bar coming down like this, then this actually is a medium-term trough, and it makes this trigger point here, and I'm using that word on purpose here, this trigger point we're going to see later on where these entries and exits occur. It makes this the point of the medium-term uptrend, and we'll put an extra T on it to say it's a medium-term uptrend trigger. Okay, because the medium-term troughs are rising. We don't know where the next medium-term peak is going to be because it hasn't occurred yet, but we know wherever it does occur, it will be higher than this medium-term peak. Okay, moving along. How are we travelling so far? Taking it all in. Long-term trends, pretty similar to medium-term trends in that except that we are taking it up a notch. Now, I've stylised the price action here simply to make it easier for me to draw, because it would take me too long to put in probably 100 or 200 of these little lines on the chart, so forgive me for being a little bit lazy in that regard. But just imagine inside these solid black lines, there are bars on a chart, or candles. And the lines that are heading down, so like this one here, they represent short-term downtrends where we have lower highs and lower lows. We've defined that explicitly. And the bars that are heading up, they represent short-term uptrends where we have higher highs and higher lows. And over time, we are making, for example, a medium-term peak here. Let's call that 1. A medium-term peak here. Let's call that 2. And similarly, medium-term trough 1 here, medium-term trough 2 here, and so on and so on. I won't label them all, but that's giving you an idea of where the medium-term peaks are. Now, the long-term trend is just taking a step up from the medium-term trend. So the long-term uptrend will be a series of higher long-term peaks. So let's say long-term peak 1 is greater than long-term peak 0, and long-term trough 1 greater than long-term trough 0. Long-term downtrend, I'm not going to write this in, simply flip everything on its head. Okay, so the question is then, how do we define these long-term peaks? Okay, well, if you remember back, the medium-term peak was the highest point between the short-term uptrend and the short-term downtrend. The medium-term trough was the lowest point between the short-term downtrend and the short-term uptrend. Long-term peaks are pretty similar. Long-term peak is the highest point between a medium-term uptrend on its left and a medium-term downtrend on its right, and the long-term trough is just the opposite. It's the lowest point between, now we've got a medium-term downtrend on the left of the long-term trough and a medium-term uptrend on the right of the trough. Okay, good news. I've showed you in absolute 100% clear-cut, black and white detail how to define each of these things. We did them on the previous slides. So if you can define those things, by definition, you can define these things. And maybe some of these are already popping out to people on the charts. If we draw in some of the medium-term trends now. Okay, so this is a medium-term downtrend on this side because I have a series of lower peaks and lower troughs, lower medium-term peaks and lower medium-term troughs. Over here, we've got a medium-term uptrend because I have a series of higher medium-term peaks and higher medium-term troughs. Remember, of course, inside these black lines are individual bars. Over here, we move back into a medium-term downtrend and then a medium-term uptrend. And once you can plot these in, the long-term peaks and troughs should just drop out. So this medium-term trough 2 is also long-term trough, let's call it 1 on our chart. We'll call this long-term peak 1. This therefore becomes long-term trough 2. And we don't know where long-term peak 2 is. Okay, that is a question mark. We can't see that's formed, and we won't know until eventually, we get potentially a medium-term downtrend over this side, which then solidifies whatever medium-term peak that is up here as the long-term peak. But we don't know that yet. And that's the beauty of this system. Each day you get more information, which can help you decide on what to do. So the question then becomes, well, where does the long-term trend start? Well, this is one of those trigger points, very similar to the trigger points we discussed on the last slide, where we have long-term troughs in place. So long-term trough 1, long-term trough 2 is in place, but we don't know if the long-term peaks are rising because we don't know what's happened back here. Okay, so let's say this was the IPO. This is the first day that the stock ever traded. It won't be until you've gone through this period of time until you get your long-term uptrend. And this is our long-term uptrend trigger here because we know that wherever long-term peak 2 is going to be formed, it will be formed higher than long-term peak 1. We don't know where it's going to be formed yet, but we know that wherever it forms, it will be higher than long-term peak 1. So this is our long-term trigger. Now, within this slide, we've also had many medium-term uptrend triggers, don't we? This one certainly, because that's a continuation point, but hopefully you're all screaming at your screen and saying, Carl, that's your medium-term uptrend trigger right there. Okay, that's a continuation point, certainly. But that's your trigger there. This is your downtrend trigger, medium-term downtrend trigger, and there are many others. That's an uptrend trigger. That's a downtrend trigger, for example. So there are short-term triggers, medium-term triggers, long-term triggers, and we're starting to now get a feeling of when we might actually get a trade out of this system. And it is a system because it's very explicit. Okay, it is a trend following system, to be more specific. So our goal, as we've explained, is to follow the money, and that increases, I believe, our probability of success. We're not trying to fight the market. It is adaptable to our trading style, short-term, medium-term, or longer term. We've talked about, I guess, really we've implied daily charts here, but you could take this model that I've given you and use it on a 1-hour chart, okay? Now, on a 1-hour chart, the idea of what is short-term, medium-term, and long-term is going to be very different. But because each of your bars represents only 1 hour, and to get medium-term trends, it might only take a few hours or a day or two to get a medium-term trend. It might only take a week to get a long-term trend, and that's very different from a daily periodicity. You can drag that down to a 1-minute chart, and you're going to get long-term trends that occur over a matter of a few hours. So you can dial this up very easily by just changing your periodicity to make this a short-term, medium-term, or longer-term strategy, depending on your trading style. The goal is to ride out those long-term trends and therefore make larger profits rather than being a really short-term in and out sort of system. One of the disadvantages of using price action and trend following more generally is that it is reactive. We are waiting for that next bar to come. We are potentially waiting a few days to get a trigger. Especially if we're looking at long-term trends, it could be a few months. And therefore the price may have moved up or down depending on whether we want to go long or short as a result of that. So we have this trade-off between our probability and our profitability, and that is unfortunately a trade-off that is very hard to get out of when it comes to trading in general. And it does require discipline and patience, which is not really a disadvantage, but it's important to note. again, you have to be able to wait for those trends to appear. And often you'll have to tune out all the noise on Twitter or Facebook or TikTok or wherever you get your information, and be patient to wait for those signals to appear. Okay, what is the methodology? So now we're getting into the methodology part of things, and we've pretty much already explained what this methodology is. But more generally, a methodology is a set of rules which clearly and unambiguously specify the criteria that qualify a trading setup. So our long or short trade, the criteria that qualify an amendment to an existing or pending order. So do we cancel that order because the trend has changed, it's no longer valid? Do we raise the price, lower the price? Do we, similarly for our stop losses, how do we trail our stop losses? A methodology for that, and then a methodology for exiting, taking profits or cutting our losses. So the methodology I'm going to give you today is called the 3 trends model for obvious reasons. We're looking for trend alignment in the short term, medium term and long term. It is purely price action based. It is as unambiguous as if you can hover over a bar and see the high and the low, you can implement this system. Okay, the high is the high. It won't change tomorrow or next week. That is set by whatever exchange we're looking at. And as long as you can compare 2 numbers, you can trade the system, and it is absolutely black and white, and it is trend following. Okay, so let's look at our long trade entry rules. We typically have filters and signals in place. So filters are sort of longer term criteria that must be met before we look for very specific entry triggers, which we call signals. I'm using a bit of jargon here, and certainly feel free to go and Google some of these topics. So we would like to see, ideally, a medium-term and long-term trend already in place. I should say a long-term uptrend in place before we see the occurrence of a short-term uptrend, potentially a signal 1 and potentially a signal 2, the close above a medium-term peak to trigger a medium-term uptrend. So let's say we were coming down in this sort of pattern here, okay, and we have our higher troughs and we don't yet have a higher medium-term peak. We know that medium-term peak 1 will be greater than medium-term peak 0 at this point here. So at that point there, that is where that medium-term uptrend begins. Okay, so that is our signal 2. And signal 1 may occur, for example, just as relevant, right here. So this is where the short-term uptrend reasserts itself. So we are already in a medium-term uptrend, tick, and we're assuming bigger picture, right? Bigger picture, we are already in a long-term uptrend, and then that short-term uptrend appears to give us our 3 trends in alignment. Okay, both signal 1 and signal 2 occur where those 3 trends are in place. In terms of trailing our exits, okay, we may use a new medium-term trough or the break of a medium-term peak as a trigger to trail a stop loss. We might then set those stop losses beneath one of the key troughs. So it could be medium-term trough 1 or medium-term trough 2 or 3 or 4, whatever you feel comfortable with. It'll be based upon how close, how much room you want to give a particular trend. Or we might use other volatility-based stops. For example, the average true range is very popular, or a combination where we're using the average true range in combination with a price action based stop loss. Okay, and I'll just go back a slide to show you how that might work. So let's say we've got an entry at trigger point A using signal 1. The initial stop loss could be set, for example, here beneath medium term peak 1. If you feel more conservative and you want more support points in the way, you might go beneath medium term peak 0, which should act as a support point because it was a previous resistance point, or you might go as far as here, but we're probably starting to get quite a ways away from our entry point. Okay, as the price, I'm just going to the next slide, as the price continues from our entry point, let's assume that this is our entry point, and we form, for example, a new trough. So at point A, let's say this is our initial stop loss, call it stop loss 1. At point A, we may then move our stop loss up potentially, so we'll call that stop loss 2, and then it's pretty straightforward. At point B, we might then come up here, stop loss 3, and so on and so forth. But we're not making these moves, we're not taking any action until we're getting our cues from our price action, and they are 100% black and white. I won't go into great detail on the short trade because I want to get to our case studies today. I'm just looking at the time also, but just turn everything I've just drawn on the screen on its head. It's just the opposite. Okay, and similarly for the trade exits. What I did want to do today is finish off with a couple of case studies. We're going to look at a couple of ASX stocks. The first one is A2 Milk, and we know that if I had to draw peaks and troughs on that one, it looks something like this at the moment. But we want to go back to where it started to all go wrong, okay, and see if we could have spotted a better exit level. Hopefully nobody listening today has A2 Milk and they're still holding on, because you'll be kicking yourself when you see where we might have gotten out. And maybe we'll have a look at the anatomy of a major low where we've got Fortescue Metals Group, which is one of the better performing stocks on the ASX over the last sort of 12, 18 months, and see maybe, obviously we had COVID and it was coming down, and maybe, where we could have spotted it to get in. Okay, so that's the idea. We're going to go to the real charts now and do some drawing. And on screen, I have a program going. So this is this particular charting package here is called Amy Broker, not affiliated with ThinkMarkets. It's a one-off purchase. Go and Google it, all right? But it's a programmable charting package where I can go in the background and literally go, if H1 is greater than H0, and like an Excel formula, and L1 is greater than L0, then make the bar green. And if it's the opposite, if it's a short-term downtrend, make the bar pink. Okay, so it's a very simple little program going in the background to colour the bars based upon short-term uptrends and short-term downtrends. So the light green is obviously the short-term uptrend, and the pink is the short-term downtrend. And then we can get a little drawing tool like this, and maybe we'll go for a black line and draw in our peaks and troughs. And we're just starting at a point a little bit back in the past from the all-time high, and we're drawing them in. And once we've got the colours there, it's very nifty, because if they were all, for example, black and white candles, sometimes it's very hard to spot where the highs and lows are. So forgive me for taking the easy way out, but I'm sure you'll understand why. And it's also not that hard to get onto your own charting package if it is programmable, and put in some of these little rules to make your life easier as well. Okay, so hopefully these peaks and troughs are starting to look like some of the ones I was just drawing in the presentation there, and I don't know where that one's going to end, so I can't draw it. Okay, so literally I'll go escape, and we have the benefit of hindsight, don't we? We can go forward and see exactly where that one ended, and maybe we'll pick that one up and keep drawing it. It's quite an interesting one. Okay, so we're looking at a period of around about 30th of June 2020, okay? And, to be fair, A2 Milk had a pretty good rally out of those COVID lows. Okay, so this is where COVID hit. This is the move down for COVID. And then it had a tremendous rally. It was one of the best performing stocks on the Australian market. But it didn't stay that way. It's moved from 20, it's down close to around $5. What I will do now is I'll draw in, and we'll try and make these different colours. Let's go for that one. We'll go medium-term uptrend over here, and we'll go medium-term downtrend here, medium-term uptrend here, and I need to be a little bit careful on where I put these. Medium-term downtrend here, I reckon, and sometimes you may need to check some of these prices here. I wonder if that high there, 1994, how that compares to, it's actually the same. It's actually an equal high, 1994 and 1994. So technically that's not a medium-term uptrend, because those are the same. So this medium-term downtrend actually persists all the way through here until we get a little uptrend here. It's only small, but it is a valid one. Medium-term uptrend. This is pretty clear-cut over here. Medium-term downtrend. There's a little medium-term uptrend here. And let's assume that the rest of this pretty safe assumption is medium-term downtrend. Okay, let's now fill in where the long-term peaks are, and we might make these blue. So there's a little medium-term downtrend here, so let's go long. It's a long-term trough, and let's call it 1, long-term trough 1, long-term peak 1, long-term trough 2. This is going to be long-term peak 2, and so uptrend. So we've got downtrend, uptrend, downtrend, uptrend. So a little one in here, long-term trough. We're up to 3, long-term peak, let's call that 3, and we probably don't need the other ones because we're already in a long-term downtrend. Hopefully you can see that long-term trough 4, long-term peak, and that will be 4. Let me just double check I've got everything right. So we go up, down, well technically yeah, down, up, peak, down, up. Now I think that's right. I mean there's some conjecture as to whether this is also a long-term peak, but I think it's fairly safe to say that this one supersedes that one. So we'll just stick with what we've got on screen. The question then becomes, okay, if I own A2 Milk, it's done very well for me. Where do I start to get really concerned about it? If I'm a longer-term investor, I'm probably not as concerned by some of those medium-term ebbs and flows, but I certainly would be more concerned if the long-term trend turned against me. Then that might be where I would exit. But certainly, in fact, you'd have to exit. You'd be compelled to exit at that point. Lower long-term peaks in here. Long-term trough. We don't know where long-term trough is going to be when we break beneath this point here, and it's here. It's here. This is where the long-term trend changes to down. So we actually got a really early signal on this long-term downtrend trigger right there. Lower peaks, and wherever that next trough is, it's going to be lower than that one. So if you had A2 Milk, I believe that would be your exit point. And it's going to be around sort of that 1850 mark, which would have been a pretty good place to get out of it, given what it did after that. Okay, that's the case study for the top, and you'd be getting out of a long trade. Let's do the Fortescue one very quickly as a case study for the low, and we'll zoom in on what happened after COVID again. And we have a medium-term downtrend over here, a little medium-term uptrend, medium-term downtrend again, medium-term downtrend hasn't changed, but it has now. Another medium-term downtrend, back into a medium-term uptrend, and that's probably enough price action, although you get quite addictive drawing these lines in. Let's switch to finding where our trends are. So that's our medium-term downtrend here. We get a little uptrend here, back into a downtrend. Eventually we do go into medium-term uptrend, but the trigger is around about here. We have a little downtrend in here, and then we get back into medium-term uptrend. Let's draw in our long-term peaks and troughs. Let's make them blue, and there's a little one there, so let's call that long-term peak 1, long-term trough 1, long-term peak 2. So we're very much still in the long-term downtrend here. Long-term trough 2. Hopefully you're screaming at your screen already. You can see where this trend changes. Long-term peak, let's call that 3, and then this is going to be, and I've slightly misdrawn that, but it won't make a difference. Long-term trough 3, and I reckon the trigger point for this long-term trend, it's a bit wobbly here, but and you can exercise your degree of safety. Look, it's sort of here or here, depending on how aggressive you want to be. And there are, there are other ways to, other rules that you can use. For example, if you take out a long-term peak and you haven't yet formed higher peaks and troughs, the fact you've taken out that peak will set this as a trough, and the next peak will be higher. So that's a potential entry point. It's quite an aggressive entry point because you might want to wait for what we've seen here, which is the traditional sort of higher troughs come in first and then the higher peaks. So look, it's either here or there, but it didn't make a huge amount of difference. We're talking about 12 versus 1250 in the context of a move that was substantially more. And ladies and gentlemen, I can't make this stuff up. It is just higher highs, higher lows, and those are very, very explicit, very clear-cut entry points that if you get proficient in the system, you really can't stuff up, as much as I'm sure many of you will try. Okay, that's it for me today. Thanks for joining me. if you liked what you saw today, we have a bunch of other regular updates on the website, news, views, opinions, lots of charts. Head to the Market Use section to find out more. If you like, you can follow me or the Think Markets handles on Twitter, and I do have regular charts that I put out on Twitter each day. Head to the webinar section of the website to register for all of our other webinars. We have lots of them coming up. Ask the Experts next week, where you get to bring your portfolio to the table. Ask me about any stock in your portfolio, or it could be a crypto or an FX or a commodity, and I'll do a quick technical, certainly, and a fundamental where possible on that. On the 15th of June, we have our top 3 stocks series continuing, this time top 3 ASX mining stocks. We're going to succumb to the dark side here and do a crash course in crypto. We're starting to increase our coverage of crypto, and then we'll revisit our 3 turnaround stocks, which coincidentally A2 Milk was in, Appen was in there, Treasury Wine Estate was in there, and Kogan. And last time we reviewed these stocks, we said basically that we wouldn't buy any of them, which has turned out to be a very good call. So we're going to revisit those and see. We'll check the price action and see if it's time to get back into them, and we'll have a look at one new one as well. Disclaimer is very important. Everything we've just discussed today is general advice. Before making your own investing decisions, please do your own research and consider everything that you have before you. We are a regulated Australian broker. We do have some products that could see you lose more than your deposits. So again, it's important to consider your risks, read this disclaimer carefully, or if you have any questions at all, please give us a call. It has been a pleasure chatting with you today about price action. I hope this is the start of your ongoing interest in price action and technical analysis. All the best for your trading until we catch up again. Bye-bye for now.